One more time. Hey, Israel. Let me know if you can hear me in the comments because I've had some issues with my audio. But today we're going to go through um, everyone's favorite potential bank failure, Western Alliance, ticker WAL. And this is not a company that I typically cover. So I will say that. But because I have agreed to do kind of more of the banks, just to help people out to go through the financials. So, if you're only hearing the company management team, which I really recommend anyone do, then it's very hard for you to feel confident that something is okay. And then, everybody kind of has an agenda. For me, I think I'm in a strangle in this point. I may be net short. I will say that. Okay. I know that's not a great description of my position, but the banks are a little crazy and the close has been really crazy on these as well. Past performance, not indicative of future returns. And honestly, there's a lot of risk in the banks right now, one way or the other. So if it's not something that you feel comfortable playing, I'm just going to say it. Don't do it. Just watch. Okay. But, the claim that's being made is that the banks, it's all over after First Republic. And one of the challenges to the claim really is the fact that we know that the increase in interest rates is actually the reason that everybody has the held to maturity issues. So you're raising interest rates, that's creating a paper loss. That paper loss is why people are removing deposits. You just raised interest rates another 25 basis points. By you, we're talking about the Fed here. So the reason that you would then have a subsequent puke out in the two other or three other or a handful of other weak banks has to do with the fact that you didn't really give them any additional buffer. So then it comes down to what were they able to get done between you raising rates and the last time they reported earnings. So I'm going to go through the finances of Western Alliance so you can take a look and then decide for yourself what you think. And I'll try to be as unbiased as possible. But like I said, I really wanted the Fed to deal with First Republic differently, or at least give us a little bit more on the earnings, or sorry, on the call from the other day. And I didn't get what I needed. And I think I'm a little bit more generous than most people. So let me say it that way. Maybe I'm not. Put it in the comments if you're hearing other people somehow be positive. Again, this comes from @BuriedTracker on Twitter. Since I'm using his work, I always got to give a person credit because I don't do this. I'm one lady trying to make these decks. But essentially, this was created before First Republic, but after Silicon Valley Bank. I think he put this out like 2 days after or something like that. Okay. And the way that you interpret this, many different ways to interpret this, but the deposits greater than 250,000, let's talk about all the things that is. Number one, that's really wealthy clients. Number two, that's large pools of capital or smaller amounts. Like it's a lack of diversity of your client base. Okay. You can say whatever you want on the call, but if you got a bunch of uninsured deposits, you don't have diversity, because what you have is a bunch of rich people, which historically was so the way to go. And now, like, very clearly, you're getting penalized for it in the strangest possible way. What is unrealized losses as a percent of CET capital? A couple of different ways that you can think about that. Unrealized losses, that word is going to mean that you have to take a mark. It's a paper loss. And it's just the degree to which you're going to be allowed to hold your assets that you don't have to take that loss. That's what an unrealized loss of a percent of CET capital really is. And let me tell you, let's just be really clear. We know they're not coming from credit losses because no one had any credit losses of any kind of meaningful size this quarter. Okay. We had increases, baby hair. Okay. Mostly. Really, it's not. Okay. There just really aren't any credit losses. So this is mark-to-market losses that get exacerbated. In other words, get worse as you raise interest rates. What did we just do? We raised interest rates again. Why? Because everybody believes that that's the only way to take care of inflation. I think that you're really the struggle is real because the Fed isn't the only one that's responsible for inflation management. Okay. There's Congress, there's other things, but we're not going to go into that discussion. I'm just telling you what these different things mean. So how do you then read this chart? The things in the top right have very wealthy clients such that if each one walks out the door, it can really stick it to them, and also have a bunch of paper losses such that if they keep getting it stuck to them, they're eventually going to have to take a nasty mark, and then that's going to get nasty. Okay. And so PacWest, which we went through yesterday, have a look at the video, was actually, lots of unrealized losses. It's just whether or not they can keep their deposits, but they do have a reasonable amount that are insured. Okay. Whereas the reason people are so freaked out on Western Alliance is we got a lot of big deposits, and yeah, there's not quite as many marks, but look at where they sit. You know what I'm saying? So it's just about whether or not you have to take them or not. And they did take some of them. So let's then go through what they reported on the 19th in April of last week. And then we've had 2 weeks since then to kind of figure it out. Okay, share. Next slide. Okay, so just as an overview, and I've left the other banks on here so you can compare it. Revenues, which I will go through, were down 3%. And I'll show you what I mean by revenue, because technically banks report very differently than other companies. So it's not gonna jibe if you're looking at it for the first time without a little bit of help. So revenue's down 3%. EPS down 42% or down 3.6%, depending on how you think of it, the adjusted number. And the adjusted is the adjusted for the mark that they took. We'll show that really clearly. That presumes no additional marks have to be taken, or that they took it on everything, okay? Return on equity isn't gonna make sense because basically that is a fair value mark. So that's gonna come out of return. So just ignore that number. And then return on tangible common equity is 12%. By the way, it would have been as high as 12% for First Republic if they didn't have to take, so, and then you can kind of see that the banks that have enough deposits and have the diversity of deposits are actually making out like bandits. Book value at this point, I need to correct this number. It's obviously not 1.15. Apologies for that, guys. I'm just one lady. But all you do is you take whatever price you wanted. I took a $21 price because originally I was going to do this earlier today. And you divide that by 41. So right now it traded down into the close. So it's lower than 40% of book, right? Okay. So, and then you basically, whatever you think is the closing price, divide it by whatever is the book value. Those are your two book value numbers. So if you're doing this at home, what you'd want to do is you'd want to take that 47 and 41, write it down so you don't have to find it in their documents, and then whatever the price is, divide, and that'll give you your price to book value. Okay, price to book value is going to be more about when someone buys this, how much they make at this point versus, or if they survive. Okay, right now, book value, the fact that it's really cheap isn't helping you out, because what we really have as a risk is bank run risk, okay? And bank run risk is whether or not those deposits are sticky enough. Everyone else trying to do whatever it is, good for them. The point is, are you going to have enough cash for what is required by law for you to hold as relates to the loans that you hold, or alternatively, any number of other things? Great. Net charge-offs were a big fat nothing, 5 basis points. 5 basis points is 0.05%. That's up from 0%. So it's nothing. There were no losses. So if they don't make it, whoever buys them makes out like a bandit, because they'll probably buy it for cents on the dollar, knowing that everybody is selling and doing exactly the same thing. It is literally like 2008. You wanted to sell your house just to have more cash. It would have been the dumbest time to do it. Unfortunately, because of the way that regulations work and laws work, that's what everybody's doing. So it sucks. And then CET capital ratios is an increase. Now, let me actually show you the detail. Hopefully that's just the top line so that you can compare it to what everybody else is doing. Here are their deposits. The deposits were 53 billion at the end of the year, down to 59 billion they were seeing when they reported in April 14th, and then at a low of 47. So their whole point is, hey, we're doing great because more deposits came in. But I'll remind you guys that before First Republic went down on its deposits, Silicon Valley Bank folks went to First Republic. So, kind of take it with a little bit of a grain of salt, but that kind of is what it is. We still need to solve whether or not these guys whether these deposits walk out the door. So it's whose deposits are they is a real question. Okay. Now, pretending like you are somehow better than First Republic at 73% insured, I don't know where you're coming from with that. You were 50% insured. First Republic, we don't know what it was on the on the 31st. I can take another look, but when they reported 2 days after the earnings report of this company, they were 27%, they were 73% insured. So everyone pretending like these banks look very different, that is not the place at which they look different. If anything, First Republic also had all this debt outstanding so that they could then pay liquid cash to other folks. That doesn't make it great though. Okay. So obviously we know what happened to First Republic. Now we are here. The only thing that is a little bit different is the size of First Republic being such a significantly larger bank and then losing 100 billion deposits. These guys lost a lot less in deposits, but let's talk about why. Okay. This was their March 16th release. As of March 16th, they were at 55% of total deposits for insurance. So they amped that up, and they did that by selling assets, and they actually ended up below the CET capital ratio in doing so, 7.9%, which they then, through the liquidation, were able to bring it back up. Okay. So that's how it looks. You've got to hit your mark on CET or else you get penalized. Although, these are just regulations, so they can be relaxed. They can be whatever it is as far as that goes. This actually is what they call sticky deposits. And this one, if for no other reason, if you hear nothing else, but you happen to have a homeowners association, this is what the bank is depending on right now, is for homeowners associations to not pull their deposits. But that scares me a little bit, because if I just think about my own homeowners association and how big that one sum is, so it's one guy at the homeowners association that decides whether $1 million, which is what my homeowner association has in deposits, if he walks out the door or just decides to go to some other higher interest bearing account, then you lose a chunk. That's what it means. That's what this chart means. Okay. That's what this chart means as relates to deposits greater than 250. So first, even if none of these banks, and we solve this banking crisis, if you have a homeowners association that hasn't thought this one through, definitely make sure they think it through and act sooner versus later, because again, it's uninsured. Okay. So that is what it is. That one I thought was weird. But the other thing related to the deposits, and let's go through a bit. Composition of deposits. This is where we're at. You can see that the cheap deposits, which is non-interest bearing. Okay. That's when you put money in a savings account, they give you nothing back. Right? That one we all know because we dealt with it for years, but now we've got options. A girl's got options on where she can lodge her money. Your option is now to go with interest bearing accounts, at which point you would, get closer to these rates here on the right, which are as high as 4% in some cases on yields. So 23 down to 16 on the cheap money. And then all the other money is expensive money. That's why the earnings is going down. We can see that not here, because this slide, while helpful, is a hard slide to see it in, but you have to actually look on the income statement. They provided a lot more detail in the income statement than I'm accustomed to seeing, but everybody did that. It's not that I don't understand it. It's just, it's really interesting how much more detail these banks are trying to give to try to help people out. So if you look on the deposits here, it's right here. You can't, so interest income is the income that a bank makes by giving the loan, and then there's expenses off of that. Here you can see the interest expense was significantly higher, from 35 million to 359 million. So even though loans much higher, interest income much higher, why? Because we raised rates relative to last year, 400 something basis points, right? This is also, the expenses associated with that are higher. And also, because a lot of that was non-interest bearing, all that's moved. So this should get worse, not better. So you should see margin compression, even though they're telling you they're getting like 350 basis points on the spread. I don't know that sticks. We shall see. But that's kind of why people are freaked out about that. Okay, so provision for credit losses, you have to take this number down here if you're going to try to compare it to other banks so that you can see what the loss ratios are. In fairness, losses are very weak across the entire spectrum of banks, but some of them have higher, some of them have lower. And then the other income that they have is fee-based income. And fee-based income was down on the quarter because of fair value adjustments, this 147. If you add back in the 147, you still get fee-based revenue down. Why is fee-based revenue down? fee-based revenue is down because at 4.5% on the funds rate, you can't, like, your mortgage cost is crazy. That's why it is. That's why it's down. So because their fee-based revenue isn't from asset management or something like that, their fee-based revenue is from making loans, and people aren't taking out loans right now because they're freaked out at how high the interest rates are. That's how you end up with fee-based revenue down year over year. And then on top of it, add the mark-to-market marks on it. Okay. That's what that is. And it's a little bit more, because of their mix, it's the thing they ended up having to talk about a little bit more. Everybody has this. This is why I keep saying, are we going to just break the banking system in order to, in theory, solve inflation, but in practice, the real thing we need to do is fiscal, not monetary? Okay. Couple more slides here. Interestingly enough, if you're reading this for yourself, realize that there are two spots that you have deposit expenses increasing. You have just loans off the loans themselves, and then you have this non-interest expense. So even the fee-based stuff has deposit expenses increasing. So realize there's two spots that it hurts it before you get to net income, which is 142. Add back in the mark, you still have you have 60 million in marks. So that's how you would have ended up with a little bit of a gain this quarter. Then you adjust for taxes, and there's all these other things. Okay, so that's why when they reported this crazy spreadsheet that we were all supposed to look at, it's $2.30 versus 2.22 if they survive. Okay, if they survive is the real question there. Now, let's see. I'm going to go, before I go to the balance sheet, I do want to just make one comment why if they survive is so important. Realize that the way that First Republic done leaves a very bad taste in a lot of investors' mouths, because essentially JP Morgan took in all the assets and potential gain, and the shareholders getting a big fat donut. So that's why if they survive, you want to support the stock. And that's why I said the other day on PacWest that the way that First Republic was done is problematic, because does it actually imply that as an investor, any banking investment, to the extent that there are assets running for the door, really means that you could truly take it on the chin? That's why it's down 30% on top of everything else that looks almost identical to First Republic as relates to the uninsured deposits portion of the book. Okay, now let's go to the balance sheet. Okay, as we go to the balance sheet, sorry, I just realized how intense I was looking. I was seeing on this. Okay, they did a good job in trying to increase cash. From 2 billion is what they used to have last year, and then that drew down a bit, and then they amped it back up from December to March. So that's not the problem. Every single bank looks like this, by the way, and you should just look at the past videos if you want to just compare it to First Republic or to PacWest. So there was an attempt across all the banks to raise capital. By the way, that also means that they're not making loans. Okay, so there's other ramifications to that on other assets throughout the market, but that is what this credit tightening situation was that the Fed was talking about the other day. Okay. Additionally, deposits, you can see them here. This is the mix again that we're seeing of non-interest bearing becoming interest bearing, and you can see where that's changed. So it's really this 3 billion of cash versus the 47 billion of deposits, and then whatever they can liquidate out of investment securities. Realizing what they already liquidated took a big, huge mark, and also some of that investment securities has, usually for most banks, I don't know about this one, I could be wrong, doesn't necessarily have stuff that's quick liquid. You know what I mean? So you can see held for sale here, and then you can see they're saying that they're held to maturity. Loans held for sale, allowances for loan losses. Actually, they're just not writing it that way, but there's no possible way. Every bank has something that's held to maturity, unless that's what they're calling investment securities. I apologize. That wasn't clear to me on the call, how they were thinking about it. Okay. So that is what that is all about. Balance sheet wise, let me see if they did it this way. So held for investment, 46 billion net. So held for investment, 46 billion. So the held for sale is 7 billion. So they do show it. My apologies. It was shown here, as you can see. And then total assets increase from year over year, and increase even from the fourth quarter, deposits, so on and so forth. And this right here was the notice from their presentation. Hold on. It's actually, Yeah. You know what? I'm not finding the note, but there was a note in one of the documents that really discussed the fact that the mortgage fee-based revenue is less than it's been because of what we're seeing in the dynamic of the markets. Now, they also have a mortgage insurer, by the way. And so that mortgage insurer is doing fine. That's mostly because Wells exited that business. So relative to that, so if they can just make it through, it's a decent environment. But the real question is, given what the Fed has done, given how First Republic was unwound, does the market just penalize all banks, period? And then what are the implications on deposits? It's not great. Here, final couple of slides. Yeah, I think those are from. Here is, I want to show you this because one of the reasons that they cited as to why they got knocked on the chin was because they had a business that did compete with Silicon Valley Bank for the VC capital, and it was a smaller part of the business in theory. I think it's as big as 5% of VC. But they said that they really were more about the deposits from the companies versus the corresponding provider of the money to begin with. So we'll see. But this is what the deposit flows look like. And you can see the outflows during the initial period and then getting 2.9 billion. But like I said, you know, First Republic did end up taking in a lot of Silicon Valley Bank's deposits as well, you know, but I think they took most of the deposits in on the earlier part, and it wasn't until much later that you saw. I mean, they took it on the chin immediately upon Silicon Valley Bank, but then they took in deposits after they stabilized and then back up. So there's something to be said there. And let me just double check that there aren't any other notes. Yeah, this is the thing that's really, I think, really frustrating for me is that one of the things they talked about on the call was penalizing deposits for being removed from the bank in a go forward manner. So, for example, if they do the venture business ever again, they're just going to require that you hold the deposits in a sticky way. And I don't see that as a good long term move for the banking system in general. What you really would do, and there is an instrument that does that, it's called, you know, a time deposit, certificate of deposit over 6 months or a year or whatever it is. But I don't think it's realistic what they were saying as far as penalizing people for depositing in the bank. Maybe I just don't, because this is my first time listening to their call. Maybe this is an ongoing dialogue that I didn't understand, but I thought that was the craziest thing that was said on the call, with all due respect. I don't know how you win business if you penalize people for deposits. And that is all I have. Look, here's the thing. I'm negative today just because I'm still very frustrated with the Fed's move. I feel bad if anybody's perceiving this as me taking it out on these banks when I'm describing it. This bank will, and just like First Republic would have been, just like any bank will be fine if the depositors don't leave. The challenge is that what's happened is that the investor gets a potential donut for trying to support the bank and keep the stock price and hold the stock price. And if you're a depositor, you end up in any number of situations. So definitely the only real takeaway that you can take from this is if you have greater than 250,000 in an account, you need to make sure it's FDIC insured. And a lot of folks are like, well, who has $250,000 in their account? It turns out businesses that are doing a lot of transactions do. In other words, if you've got, it really, really screws up business banking in a big way. You know, if you've got payroll, for example, and you've got accounts receivable where you owe people money and certain things, I don't know how you do this without just making your poor accountant work more hours and definitely moving moving over 250 over to other things. So with that, that's like, please don't take this as I'm antagonistic to any given bank. This is not the bank's fault at this point. Okay. Maybe at a past point, possibly. I really don't know how you hedge 450 basis point move, but maybe someone else does. That would have been that wouldn't have been what I call a hedge. That's what I call a bet, but whatever, as far as that goes. All right. Let me just acknowledge some people, especially those of you that watched earlier and my sound was all over the place. I really appreciate you guys coming back and checking out what I have to say. Thank you so much. Israel, always appreciate you. coming in. My day is going pretty well, other than learning how to do audio properly. Sorry, guys. And then Jason, yeah, I think it's really messed up in a lot of ways, but it's what has been chosen. And honestly, I'm not even convinced that rates is what's needed to increase to affect inflation. And the reason I feel that way, here, I'll leave this up so that someone just coming in. The reason I feel that way is because some of the components of inflation are really suffering, right? So PPI, which is supposed to be a leading indicator. CPI is supposed to be a lagging indicator, but whatever in the new world, PPI is already showing negative and has done so for the last 2 months. And then you've got home prices, which are, rental prices, not home prices, rental prices, which are just going straight like this. That's clear both from what we're seeing in CPI and also all of the residential REITs are telling you that's what's happened. They're telling you that they're raising rents and that they've kind of had to because of, and they don't plan on not doing that because it would be the wrong move. Additionally, the only way to get that to resolve is actually to lower rates or stabilize them. Either one will do it. But as long as you keep raising it, all you do is remove housing supply and therefore increase rent. And then the other component that is up is food, and raising rates does nothing for food, increasing the amount of food. Only Mother Nature, last time I checked, can make more stuff grow out of the ground. So I'm not convinced that raising rates is the right call. I am thinking that this is a fiscal issue, but God forbid that Congress do its job, for all due respect. I mean, sorry, I'm going to throw it out there. I try to stay unpolitical, but there it is. You know what I mean? I apologize to anyone I've offended with that comment. All right. I'm not seeing any more comments. Hopefully that was helpful. Good luck to you guys. Definitely protect your own assets first and foremost, and make sure that you're under the FDIC limits best you can. Please do put things in the comments. I try to read every single one of them. If for no other reason than YouTube doesn't have a feature that doesn't let me read them. So every time I open up. And